The the Fed raised the Fed funds rate by 0.25%. I am of the opinion that that was baked into the market. It was very much anticipated. The Fed gave a clear message. Obviously, the headline is rates raised by the Fed, and so what does that affect? In the short term, it affects prime right away. So prime goes from 3.75 to 4% overnight. So all those lines of credit out there will be paying 25 basis points more in interest. But from a mortgage rate perspective, the 10-year bond really tracks the 30-year fixed rate, and the 10-year Treasury bond is tied to a lot of consumer rates. And what we saw there was actually a slight pullback off the highs. So it tells you that the old Wall Street saying rang true yesterday, and that's buy on the rumors, sell on the news. That's what happened. They ran rates up into the announcement, and they flattened out. And so we're looking at the message from the Fed. They were very dovish, talking about inflation, where wages are still low, productivity is still low. There are signs of things improving. Obviously, we've added $4 trillion of net worth to the stock market since the election. That is definitely inflationary. Obviously, for places like the New York metropolitan area, where a lot of people commute down into Wall Street, or financial firms obviously are across the country, those areas, I believe, are going to experience quite a nice spring market because you have created so much more wealth in a short period of time. The Fed will meet again a couple times through the next few months here. You're probably looking at another quarter point in June and probably another quarter point at the end of the year. That's exactly what they're saying and telegraphing. And look, if we have an economy that grows at 2.5% and 3% compared to the 1.5% we've had for a very long time in this country, we can absorb higher interest rates. People are going to feel a lot better about things. And, if their mortgage payment is $300-400 higher a month, so what? And I know that's a big concern for people with higher rates, and what does that do to values? I think we push forward. This market reminds me very much of the 2003-4 market before the craziness. 30-year interest rates were 5.25%, 5.5%, and things were pretty good then.